Each futures market has its own unique time-of-day tendencies. Even if you're a long-term trader, as opposed to a day trader, you should be aware of this. At some point, you're going to want to enter or exit the market. Know the times to seek out and the times to avoid. We'll look at the time-of-day tendencies for two primary market characteristics. First is volume. Volume is an indicator of liquidity. The higher the volume of a futures contract, the easier it is to buy and sell with narrow bid-offer spreads, creating less slippage. High-volume markets are also less prone to wild price swings. Second is volatility. Volatility is associated with risk. The higher the volatility of a market, the more you can gain or lose. And speaking of risk, always remember that futures trading involves plenty of it. We'll focus on 6 futures contracts: the E-mini S&P, the 10-year U.S. Treasury, crude oil, gold, corn, and the euro. Here is the trading volume for the first half of 2017 for each of these markets. We'll measure risk by looking at the average daily true range for each market over the month of July 2017. This is the number of points the market moved on average in one day. We'll multiply this range by the dollar value of each point. This gives us the average amount you could gain or lose in a typical day. By way of comparison, note that the potential for gain or loss in gold was almost 4 times that of corn. Volume and trading range are not distributed evenly throughout the day. This chart shows activity for the mini S&P contract for July of 2017. The blue bars indicate the percentage of daily volume that occurred in each 30-minute time span, using the U.S. Eastern Time Zone. The opening and closing periods account for 30% of the volume. There is very light trading in the overnight time periods. This shows that even a market with overall high volume can go through illiquid periods. Now let's add the gold bars, which show the percentage of trading range that occurred in each time slot. Note that in the overnight hours, there is a disproportional high trading range relative to volume. This is seen in many markets. Most people would view this combination of higher risk and lower liquidity as very unattractive. The 10-year U.S. Treasury has a volume spike at 8:30 in the morning. This is probably somewhat due to the fact that key economic announcements often occur at this time. Be aware of the day's scheduled news events and plan accordingly. As you review the remaining charts, note that gold and the euro come closest in this group to offering a 24-hour market. If you are limited in the times of day you can trade, these markets may offer more of an opportunity to fit your schedule. The message is that market characteristics change throughout the trading day. Choose the times when those characteristics best fit your trading style and the situation you find yourself in. To subscribe or watch another trading video, click below.